Let's talk about mortgage insurance. It's time to do some math. So what is mortgage insurance and why would you pay it? A long time ago, when people would buy a home, they would need to save 20% before they even started thinking about a purchase. It's all based off of risk for the bank because it's statistically proven that if someone puts 20% down on a home, they're much less likely to let that home go into foreclosure. Lower money down, higher risk, more money down, lower risk. That's going to come into play when we talk about the actual rates for the mortgage insurance companies. So what happened is mortgage insurance companies came along and said, hey, Mr. Banker, we will insure you against any loss that you have if someone goes into foreclosure, so you can lend more money, so more people can buy a home. And we have the structure that we have today. 3% down, 5% down, 10% down, 15% down, and then the magic is at 20% where it goes away. So let's see what that looks like. Let's say we have a house with a sales price of $350,000, right? And we're gonna look at 5% down, 10% down, 15%, and 20%. So that's your down payments. We're gonna have a different insurance rate because it's based on risk, like all insurance is. I'm gonna use a factor of 0.79. Now, this is all gonna be based off of credit score, how many people are on the loan. There are all kinds of things that go into the mortgage insurance calculation for the factor. It's just like your car insurance or your home insurance. There's a lot of factors that go into it. But just for information purposes, just to be able to see how this works, I'm going to use an estimate on each one of those. So we're going to use 0.79 here. Here, we're going to use 0.54. Then here, we're going to use 0.23. And then this is 0. Because at 20% down, you no longer have mortgage insurance. So if we use these factors, it's not very complicated to calculate. I'm going to take 350,000 times 0.79%. I'm going to divide that by 12. And this mortgage insurance is $218 a month. I'm going to do the same thing with the 0.54 based off of the 10% down. And here, it's going to be $142 a month. When we get to 15% down at 0.23%, this goes all the way down to $57 a month. And then when you get to 20% down, mortgage insurance goes away. Now, keep in mind, this is conventional lending only. FHA, VA, USDA, all different things. This is for a conventional loan only. So in the case of most first-time homebuyers, it is worth it to keep your money in the bank, put down 5% and pay this. But you may want to go up if you have the means and you can go up by another 5%. You're going to save yourself $76 a month. So is it worth it to put down the extra 5% and save $76 a month? That is completely up to you. So this is why loans are not one size fits all. People have different scenarios, different credit scores, access to different funds. They have other things going on in their life that they need their money for, or it makes more sense to put that money into a home. So if you have questions about mortgage insurance and what fits your scenario the best, let's chat.